Hello, everyone. This is Sebastian McMahon from IA Financial Group. I'm back with another edition of the weekly economic review, this time for the week ending July 29th, 2022. So after being away for a few weeks, I will be recapping the whole month of July, the main theme. So this one might be a bit longer than usual, but let's start with the action in the markets this week. So as you can see from the chart, the table here, well, we had a positive week for bonds and a positive week for stocks. So interest rates are starting to move down. That's a good thing. I don't think that we will be seeing all of the negative returns from the year being washed away by the end of this year. But as we've mentioned multiple times, starting around mid-2022 with the rise in interest rates, bonds started to be interesting again after one of the worst half to a year in history. Now, good news, bonds are starting to contribute again to returns in portfolios. So let's see, we'll discuss that in a few minutes. But the long bonds returned 1.6% on the week. We're still down 16.4%, but at least looking forward, we think we're in good shape here for bonds. Stocks were positive week 2. The TSX was up a bit less than the S&P 500 in local currency, but when you bring everything back into Canadian dollar, we had an outperformance on the week. S&P 500, NASDAQ up, EFI up, emerging markets a little bit weaker on the week, but still positive returns there too. So we'll see. We'll do an update on the state of the stock market in a few minutes. Price of oil was higher on the week. Canadian dollar stronger by close to 1%. The price of oil positive on the week, still volatile and down on the year. So the recap first for July, we have the inflation figures coming out. So we've been discussing that ad nauseum, but over 9% in the US, 8.1% in Canada for the month of June. Of course, I've been mentioning that for a while. We're getting closer to a peak. At first, we thought the peak would be somewhere in late spring, early summer. Then with the rise in the price of oil and commodity prices coming from Russia and Ukraine, pushed that a bit further on. Now, is this the peak? I mean, we're getting closer to it, of course. But if you look at the price at the pump, so gasoline prices, we had the strong pullback in July. Prices are still elevated, but we had a pullback from very elevated levels that were in June. So probably that's going to mean slower inflation in July. So we'll see how the math come off. The price of gasoline, of course, pushes the prices of many things higher, like food inflation. Of course, everything you buy at the grocery store is transported by a truck at some points. So there's gasoline prices embedded in those price, but we'll see if we are getting closer to that. But the good news is that we're seeing some respite at the pump, and that's good for consumers. So let's see if that was the peak, but 9%, that's quite elevated in the States. And if you look at central banks, of course, you had the Bank of Canada hiking 100 basis points or 1% in one go earlier this month. That's 4 hikes in one. So that was a very strong signal. In the US, we had 2 consecutive 75 basis points hikes. So in Canada, we went 50 and 100. In the US, it was 75, 75. So that was them looking to get to neutral as quickly as possible. And they've done that in 2 meetings. They went from about 1% to 2.5%. And neutral is their estimate of neutral from both central banks is between 2 and 3%. So they estimate that then they're not at least creating inflationary pressures by having interest rates too. Now looking to go above neutral to rein inflation in. Both central banks are flagging that more rate hikes are coming over the next few months. The market is starting to price that central banks will be done by the end of this week, this year rather, in December. That will be the last hike, and we'll see. But now central banks are starting to talk about being data dependent. So when you look at data dependence, that means that they look at the state of the economy, and you don't want to tip the economy over into a recession, on purpose. So that brings us to the economic data. data. So you have US GDP here. So we're already in a technical recession in the US, technical meaning Q1 and Q2. So two consecutive quarters negative print, so contraction in GDP. So that's a technical recession. It's the NBER committee in the US that decides when there's a real recession, and they can label the economy as being into a recession. They haven't done so yet. And typically, historically, when they label the economy in a recession and they identify the dates, we're after the end of a recession. So it could be multiple months before they make a call on that. But we are seeing some weakness in the economy. We're seeing a weakness in the consumers is slowing down. Housing's becoming an issue. Business inventories are being lowered. So this is a drag. You're seeing investment that is stalling and a bit negative. So you're seeing all of these elements unfolding, and we do still think that over the next 12 to 18 months, we're going to have multiple negative stories just following one after the other, and we could see very little growth over the next 12 to 18 months. So will there be an official recession call at some point in there? I don't know, but it's important for earnings. If you have a stagnating economy, then business earnings are going to be slower, so that impacts the stock market. So we'll see where we're at, but a slowing economy means probably that we're getting very near to the end of rate hikes, and we do believe that most of the rate hikes of 2022 are already in the books. Might be some adjustment left, but we're not going to be seeing this pace continue, forward. So the stock market, the recent rebound, the recent rally that we've seen continues. Typically in bear markets, you have multiple bear market rallies. So it's kind of tricky now to say, was the low of June the bottom of the market? We still think not. A bear market is a process. It takes a while. Usually a bear market lasts for a year, and the one in the US started in the US bear market started in January. The Canadian stock market is not in a bear market yet, hasn't pulled back for about 20% from the recent highs, but still, if the bear market in the US continues, of course, it's hard to see the TSX, diverging strongly from the US stock market. But now we're in bear market rally number 4. I'm not a technical manager at all, but I read a lot of the technical analysts out there, and we're hearing a lot about the resistance at 4150. So maybe we're going to be hitting that. And also the question is, did we see the absolute bottom in June? And for a bottom to be considered a sustainable bottom, the absolute bottom of a market, you need to see multiple things in participation to the upside of the big names, and the breadth of the market on up days, and these things need to be off the charts, and we've seen almost nothing of that yet. So yes, the market is rebounding. It's nice to see a rebound, but I would be careful before thinking that, all right, the coast is clear, market is going back up. There might be some more volatility coming for the future. And again, maybe wrong on that, but I mean, history as a guide tells us that what we're seeing now is just purely regular bear market activity. So here, maybe just to give you in a table some research that we've done on a bear market. So first we did that just quickly to make sure to have something to bring to you today. This is over the last 50 years, so since 1969. Bear market rallies, generally, on average, you have 8 of them. On average, always have to be careful with averages, but on average, you have 8 of them per bear market. Now we're at bear market rally number 4. The minimum we've had in the past was 4, maximum was 13. Bear markets, they tend to last for about a year. Now we're 6 months in. Bear markets tend to mean that at some point we reach minus 30% on average. We reached minus 24% in early June. So history as a guide tells us that there might be some more drawdown to come in. Again, as I mentioned, with the US economy slowing down, the earnings for businesses probably will be revised lower. So that means probably there's going to be some more profit taking, and stocks could be under pressure for a little while here. So this is the picture as of today. I would remain careful before saying that, coast is clear, buy stocks. June was the absolute low. I would say this, that if you're a long-term investor, and I always recommend everyone to be, if you're buying for the next 3-5 years, right now, that's a very good entry point. I mean, when the market is already down, almost 20%, it's good to buy and to just wait it out if you can live with some volatility in the short term. If you want to have the best entry point possible, I would recommend that you wait a little bit, but always the best strategy is periodic buying. So I will always recommend that you do that. So that's it for stocks. For the interest rates now, have we seen the peak in interest rates for 2022? This starting to be a bit clearer. We do think that it's pretty likely that we've seen the peak in rates in 2022. We'll see, but the likelihood is pretty elevated. The 10-year rates that you see on your screen here, they went up pretty quickly early in 2022 as central banks are talking about tightening their leading rate very quickly and at a strong pace. So long rates react to the expectations of a move in the short-term rate. Now that central banks have pretty much flagged that, all right, the autopilot part might be done. We are at neutral now, and the economy starting to show some signs of weakening. Then you're starting to see a coming down of interest rates. And if you look at the upcoming weakness on the economy and the fact that central banks will have probably to stop their hiking cycle somewhere in late 2022, well, maybe that means that the peak is in for interest rates. So the beginning of the year was very tough for bonds, as I mentioned earlier. One of the worst periods, the first half of the year in history for bonds. We've mentioned that multiple times as we were getting into the summer, that bonds are starting to be more attractive, forward-looking, and we're in that environment now. So we do think that bonds now, thankfully, will be playing a more important role in portfolio returns. And this is part of our strategy. We started adding bonds in April and May, and we're still adding. So now we're overweight bonds and we're benefiting from a possible peak in interest rates, but the positive returns now coming from bonds. So we'll keep you posted on all of these stories, but more positive view on bonds looking forward, starting from these levels. So what to watch next week? So it's going to be the first week of August. So it means we'll have the employment reports on both sides of the border. We should have gains on both sides. And we'll also have the ISM manufacturing and ISM services index in the US. We still think that we're slowly but surely going below 50. So we're expecting a slower pace of growth here. So that wraps it up for the week. Good to be back. So ia.ca/economy is your go-to webpage. You can find everything that I produce there. You can follow me on social media, Twitter and LinkedIn. Economy and Finance 101, there's some new material out, so I encourage you to take a look at that. And again, another publicity for the podcast that we've put out. So in your interest, that's we recorded lots of material. We're publishing some new material every other week. We're just about to enter the studio to record another batch of episodes, and this is something that's going to be a staple of ours for the next many years. So I encourage that you take a look. I'm sure you'll find a few interesting tidbits in there. So thanks everyone for following us on a weekly basis. Good to be back, and I'll be back again next week with another edition of the Weekly Economic Review.